Are there any other countries also where NRI residents can claim zero taxation on mutual funds capital gain in India?
Countries such as Kenya, Saudi Arabia, Oman, Kuwait, Singapore, and few of the European countries, be it Sweden, all are having the similar provisions as mentioned in the DTAA.
What is DTAA?
See, Ankit, DTAA is Double Taxation Avoidance Agreement. Before that, let's just discuss what is double taxation.
It says that except for shares and property, everything else will be taxed in the country of residence. Correct?
Correct.
So recently when Nilesh Shah, who is MD of Kotak Mutual Fund, talked about how NRIs based in certain countries can save paying tax on capital gains in mutual funds, it went viral. But for us at Wealthy Nivesh, it's an older story. For us, it started when Shashin, who's a senior journalist with HT Mint and who's a very good friend also, published a story on how NRIs based in UAE can save paying tax on capital gains on mutual funds in India. So what we did, it was a story even for me, in spite of the fact that I have worked for more than a decade across India and UAE in wealth management only. But even for me, it was a new story. So what we did at Wealthy Nivesh, we did two things. First, we reached out to all the mutual fund houses in India and we took their clarity on the matter. Whether they will be able to avoid TDS on redemptions for, say, UAE-based clients. Parallelly, we talked to our affiliate, which is CSPS, which is a leading CA firm, on the intricacies of the context. So, while on the one hand we got clarity from AMCs that yes, this is possible, from CSPS we got the behind story in very much detail and also we expanded canvas beyond UAE. So, CSPS helped us understand that this context can be applied to four more GCC countries, which is Saudi Arabia, Oman, Kuwait and Qatar, in addition to UAE of course, and also to Singapore. The good thing was that CSPS also showed us many judgments by tribunals, by courts which supported the idea. But for us the preferred mode was avoiding the TDS itself. So we reached out to AMCs, we took their clarity. More so those fund houses which we recommend as part of our baskets at Wealthy Nivesh, we took their clarity. They shared the documents with us and then only we started, we started reaching out to our clients and telling them that this is how it can be done. Fortunately, in the March month, at the closure of the financial year, we were also able to get some redemptions done without TDS deducted by facilitating the documentation with the respective fund house. But to discuss the context more in detail, today I have got with me Shubham Patel, who is managing partner with CSPS, who personally has worked a lot on leading all the DTATs, on going through all the tribunal decisions which are relevant for this particular topic, and who came out with a literature for our clients for the same. If you want that literature, you can drop in your email ID or WhatsApp number in the comment section and we will share it with you. Welcome Shubham, welcome to the episode.
Thank you so much, Ankit. Thanks for inviting me again to this podcast.
So Shubham, let's go step by step.
Okay.
Let's first explore what is DTAA.
See, Ankit, DTAA is Double Taxation Avoidance Agreement. Before that, let's just discuss what is double taxation. See, double taxation is where you are taxed doubly once in your country of resident and the country where the income has been sourced, or the country of origin or where you have earned that income, right? So in such case, there would be a genuine hardship on the taxpayer if he had to pay at both the countries, right? So here comes the DTAA, or Double Taxation Avoidance Agreement. India has entered into bilateral agreement with the multiple countries. Currently, there are more than 94 countries. So there is some literature in the DTAA where everything is mentioned article wise, be it any type of income, be it salary, capital gains or any income. So it has been written that particular source of income will be taxed at source country or the country of resident. So everything is mentioned in that agreement only.
Great. So how does DTAA
Hmm.
applies in the context of mutual fund capital gain taxation in India?
Okay.
If you can take some example and help us understand.
Got it. So one of the article of the DTAA talks about capital gains, particularly on only on the capital gains. So let's discuss about the UAE's case. So in case of UAE, the article which talks about capital gain is Article 13, and in Article 13 there are 5 clauses, out of which first 4 clauses talks about immovable sale of immovable property or shares or any particular capital asset. So the power to tax rests with Indian government only, or the country where you have the actual source of income. So let's say if you have any property in India, so the power to tax rests with Indian government only. If you are selling that property in India, or since you have the property situated in India, the power to tax by default, the power to tax should rest with the Indian government only. But in case of clause 5, which has written that any other assets which are mentioned in the above 4 clauses, right? So the power to tax rests with the country of residence only. So in the UAE's case, the power to tax rests with UAE government only.
So from what I remember reading the DTA between India and UAE, it says that except for shares and property, everything else will be taxed in the country of residence. Correct?
Correct. See, the first 4 clauses are immovable property and shares. The fourth one is shares. Any other property includes mutual fund, rights entitlement, and so on. Since the mutual funds are not direct shares, they are the units. See how mutual fund works. Any particular unit holder invest any money, gives money to the fund manager or AMCs. In exchange to that, AMC gives them units of the mutual fund, and in by default they are forwarding or passing on that fund to the various securities, be it equity, bonds, or anything. So actually mutual funds are not direct shares, they are units. So it should come under the residual clause, where the power to tax rests with the country of resident only.
And from what I believe, there are judgments also supporting this. Correct?
Yes, there are many judgments. The first one is related to this UAE NRI, where Mr. Faisal, which was a resident of UAE, had some capital gains on sale of equity mutual funds, where the assessing officer dismissed his claim of such exemption. He went to ITAT, this tribunal, Kochi tribunal, where Kochi tribunal held that equity mutual funds or mutual funds are not shares. On that basis, he got the exemption on sale of mutual fund. In fact, we have very recent case law which was held by the Mumbai tribunal in case of Anushka Shah versus DCIT, where she was a resident of Singapore, where she sold debt and equity mutual fund. So in her scenario as well, Mumbai tribunal held that equity shares are not mutual funds. Mutual funds are units and equity shares are the normal paid up share capital.
Great. So from what I understand, so because the clause is ki you have to be resident of a certain country.
Yes.
Correct? And there will be some proof for the same,
Correct.
and that is supposed to be tax residency certificate.
Correct.
So there are two questions. So looking from Indian side, you are an NRI if you are for more than 182 days outside in a financial year. Correct? But from UAE side, you have to be resident over there for more than 182 days. Then only they
Correct.
will give you TRC.
Correct.
So let's take a scenario ki I am staying out of India for more than 182 days, but in UAE I am, staying for let's say 90 days, and other days I am in other countries.
Okay.
So that way I won't get TRC from UAE. Correct?
Perfect.
Great. So help me understand. So I'll get a TRC from UAE government mentioning that I have stayed for more than 182 days in United Arab Emirates, basis my travel history with them for respective calendar year or financial year. Correct? And then I will complement it with 10F certificate from Income Tax Department in India. And basis that at the time of filing the ITR, I can claim back the TDS deducted.
Correct.
Great. But so what we are doing at Wealthy Nivesh, we are trying, we believe that prevention is better than cure. So we are trying that your TDS itself is not deducted.
Correct.
But help me understand, if AMC is not deducting the TDS, even then at the time of filing the ITR, you have to declare all the transactions and you have to produce the documentation. Correct?
Correct. See, actually, as per my understanding and as per my statistics, every 3 out of 5 NRIs, they don't apply for TRC. The first and foremost important thing is they need to apply for TRC. They need to apply for TRC and file Form 10F with Indian authorities and submit these two documents to the AMCs. So if they missed to submit this document to AMC, and by default, AMC will deduct tax while paying
Along with certain declarations from the AMC side also.
Yes, yes, correct. So if they miss to submit this document to the AMC, the second option rests with them is while filing their ITR, they can claim back the TDS which has been deducted by the AMC at the time of redemption. But at the time, but the only thing they need to be cautious about it is they need to apply for TRC and 10F before filing of
Before
ITR.
the filing.
Yes.
Correct. So it should be valid on the date of redemption.
Yes, it should be valid on the date of redemption. Correct.
So one is prevention, the other is cure. So there is one way ki at the before redemption itself we file TRC and 10F to the respective AMC along with certain documents, and AMC won't deduct the TDS if they are satisfied with the documentation.
Correct.
But in case I have done the redemption and my TDS has got deducted, so what will happen in that case?
So see Ankit, it's very simple. You need to apply for TRC and 10F. Once it is applied, you need to submit this document while filing your income tax return. You can file your income tax return and get back the TDS which has been already been deducted, if TDS can be refunded or adjusted with your any tax liability of any other source of income. Right? You just required to get these two documents before filing of income tax return. It's very simple.
Okay, so for the benefit of our audience, there are two ways by which you can save your tax. One is that you avoid paying the TDS itself, that your TDS is not deducted. That will happen before the redemption. So before the redemption, you will avail TRC, you will avail 10F, and there are certain specific documents for every AMC, which we at Wealthy Nivesh can help you with the same. And at the time of redemption, if your documents are proper, your TRC date is proper, your TRC is valid, then TDS won't be deducted. But in case TDS has been deducted already for whatever be the reason, then at the time of filing the ITR also, you can claim back the TDS basis this context.
Yes, correct.
So Shubham, we discussed about UAE, we discussed about Singapore, but are there any other countries also where NRI residents can claim zero taxation on mutual funds capital gain in India?
Yes, definitely, Ankit. There are many countries having similar provisions as mentioned in the DTAA with UAE. Apart from UAE, the countries such as Kenya, Saudi Arabia, Oman, Kuwait, Singapore, and few of the European countries, be it Sweden, all are having the similar provisions as mentioned in the DTAA. So you can get these benefit of capital gains on mutual fund if you are residents of these countries.
Great. Thank you, Shubham. Thank you for sharing all this knowledge. But apart from sharing this knowledge also, let me take this opportunity to thank you from the depth of my heart for all the hard work that you have done in going through all those many DTAA, digging out all the relevant judgments, tribunal notings, etc., which certainly will help a lot of NRI clients for sure, and NRI investors in mutual funds in India.
Thank you so much, Ankit. In fact, I would like to appreciate you and Wealthy Nivesh for sharing such a knowledgeable content to your audience and your clients as well.
And specifically, the literature that you have generated on this topic has got very good feedback from the people who are going through it, and they are very appreciative of all your efforts.
Yes, glad I like that.
Thank you, everybody. If you have any query regarding the topic, do drop in the comment section and we'll come back to you. Or you can also reach out to us on our LinkedIn page, Facebook page, or Instagram. Thank you. Thanks a lot, Shubham.
Thank you.